Okay, another factor that's been influencing inflation in Australia is slower overseas growth. So China's growth has fallen from around 8% to 6.7%, and growth remains weak in lots of Europe and other parts of Asia, including Japan. So slower growth rates overseas, that means that overseas countries demand less of our exports, particularly our commodities like iron ore and coal. That's likely to, because they don't need them to fuel growth and infrastructure. This is likely to reduce the incomes of those overseas, and could also lead to reduced tourism and demand for education in Australia. So it's important to recognise the industries that suffer, which would be tourism, education and mining industries in particular. This results in reduced net exports, diminishing profits for export industries, and that's likely to lead to lower factor incomes and therefore less consumption spending, which should overall reduce demand pull inflation in the economy. Investment spending may also fall because businesses will experience decreased business profitability. So it's key to recognise the decrease in net exports, the decrease in consumption, and the decrease in investment spending, mention particular industry, and link that to reduced demand pull inflation. In terms of consumer confidence, look, we're mainly below 100, which sort of means that there's more pessimists than optimists, but overall, consumer confidence hasn't changed a lot. It's important, if you do get a question on consumer confidence, that you define it as the level of optimism that consumers have about their future economic prosperity. And then as consumer confidence increases, they have a greater marginal propensity to spend or consume, they save less, and that should help increase consumption, spending, and demand pull inflation. So it can cause some inflationary problems. In terms of business confidence, a common mistake is people go straight to supply. It's important to recognise that when business confidence is high, that's going to lead to businesses being more optimistic about their future sales and profits. This is likely to lead to firms investing more. So firms will invest more in the short term, and that increases aggregate demand, not aggregate supply. This will lead to a short-term increase in demand pull inflation because investment spending is a component of aggregate demand. So overall, investment spending and aggregate demand will increase. In the long term, increased business confidence may help to reduce cost push inflation because businesses may invest in productive investment, which boosts their productive capacity. But in the short term, business confidence is all related to the increase in aggregate demand. Lower terms of trade we won't worry about that. We'll talk about that in the next area of study. Lower company taxes. So the government reduced company taxes to 27% for those businesses earning less than $10 million in the recent budget. In the short term, lower company taxes also increase demand pull inflation. So lower company taxes mean firms may have increased incentive to invest in new capital and machinery. This all helps to boost investment spending and can cause some demand pull inflation. Lower company taxes may reduce cost push inflation because businesses are taxed at a lower rate. They have decreased production costs. So there's a decrease in their production costs, which may lead to lower prices. But overall, lower company taxes will increase inflationary pressures because they lead to increased investment, and that outweighs any things today associated with lower production costs because of the increase in supply. Increased productivity. Productivity helps to reduce cost push inflation. When you're talking about productivity, it's important that you define it as the level of output per unit of input, and in more detail, it's about how efficiently we can use our resources, land, labour and capital, to produce goods and services. As productivity increases, firms' costs of production go down because they can generate more output per unit of input. That helps to, and this is really important, higher productivity helps to reduce labour costs per unit of output. So it helps to reduce firms' real unit labour costs, which should help to reduce cost push inflationary pressures. The participation rate. So lower participation rates may hurt inflation because it will lead to reduced competition within the labour force. That can lead to higher labour costs as the demand for labour outweighs supply, and that can potentially lead to increased costs of production. It can also lead to reduced productivity because we lose productive older citizens, and that can also lead to cost push inflationary pressures. So an ageing population can be bad for inflation on the supply side. Slow growth in wages. This is a really important one. Okay, the wage price index is just above the rate of inflation at the moment. So what that means is nominal wages are increasing slightly more than inflation, but not much at all. And this should help to reduce production costs because if firms can increase productivity by a greater increase than the increase in wages, they will experience lower real unit labour costs. So the lower growth in wages, assuming there's an increase in productivity, will reduce real unit labour costs, reduce firms' costs of production, and reduce cost push inflationary pressures. And that is a really important one. Oil prices. Oil is cheap. Oil is used in a lot of production for fuels, heating, plastics, insulation, electricity. So when oil prices go down, firms' costs of production should go down, and firms should have supply side benefits. In terms of recently, as you can see, the price of oil went down drastically from 2014 to 2016, from $100 to $40 a barrel. That helped firms to reduce their production costs and reduce cost push inflationary pressures for businesses. It can also directly reduce the CPI because oil is included as part of the CPI. Consumption and production subsidies, be careful if you get these. Production subsidies reduce firms' costs of production because the producers get some form of assistance, so that helps to reduce inflationary pressures. It also encourages them to invest in new capital and equipment, but overall the reduction in production costs should help to reduce cost push inflation. Consumption subsidies, on the other hand, they are given to consumers, so they actually lead to more demand and lead to more demand pull inflation. So if we give the consumer the subsidy, it will actually lead to more demand pull inflation. Poor climatic conditions, they have a negative impact on agricultural products. That leads to increased cost push inflation as it's more costly for firms to manage their crops. Any natural disasters will shift aggregate supply to the left, which will generally lead to higher prices. It'll generally affect headline more than underlying because it'll impact the prices of volatile items, but it can have some impact on underlying inflation. The other thing with natural disasters is they often lead to more aggregate demand because we need to reconstruct the buildings and recover what's lost. That can lead to demand pull inflation as well. And finally, indirect taxes. Indirect taxes are placed on producers, so be mindful that anything like an excise tax or a carbon tax actually increases cost push inflation because they will lead to higher costs of production. Excise taxes are generally only placed on certain products and therefore only impact underlying inflation. So in terms of being really current, if you get asked for factors, a good supply side factor is lower wage pressures. Link that to real unit labour costs. You can also talk about lower petrol prices. You can also talk about weak overseas growth if you're going to link it to demand pull inflation. From a headline inflation point of view, lower interest rates are increasing demand pull inflation, but potentially reducing cost push inflation. The low Australian dollar is causing both demand pull and cost push inflation because it's leading to higher costs of production and demand for our exports. So there are some really current things you can use at the moment. Thank you.